Good morning, good evening, or good morning everyone, good afternoon I should say. Thank you very much for joining us on this webinar. I'd like to welcome you all to our webinar. I'm Paula Allerton from Equiteq at our New York office. Today our webinar is focusing on our proprietary M&A research in which we examine the consulting firm buyer's perspective. During our webinar we welcome you to pose questions. You can do so using the toolbar on the right side of your screen. We'll take the questions at the end of the webinar in the order that they are received. However, if you have clarifying questions, we will try to make sure those are addressed immediately. Our presenter today is David Jorgenson. David is the Global Head of M&A at Equiteq. David began his career growing networking and Internet consulting firms in the mid-1990s. He completed his MBA at Duke University before joining Robert W. Baird in Chicago. While there, he provided M&A and corporate finance advisory to professional services, outsourced business services, and technology companies up to $2 billion in value. During his 20-year career as a technology consultant and investment banker, David has advised business owners, shareholders, boardrooms, and C-level executives on every aspect of growth and value realization. David joined Equiteq about a year ago and is based in our New York office where he runs our global M&A practice. Over to you, David.
Thank you, Paula. Very glad to have the opportunity to talk to you all today. Thank you for joining. We are very excited to be discussing with you today the results of our proprietary research into the consulting M&A market, specifically from the buyer's perspective. We hope that the discussion today is informative and educational for you. I will move through the slides fairly quickly because I want to have time at the end to address questions. So please feel free to use the question box in the webinar toolbar to enter your questions, and we will, at the end of my prepared remarks, we will be certain to run through and answer any questions that we find. So on the agenda for today is a discussion of our proprietary research around buyers' perspectives on acquiring consulting firms. We have organized our insights into 5 key insights that we think are important for consulting firm owners to understand as they're thinking about their approach to the M&A market. So I'll talk a little bit about how we designed the report and how we commissioned it, what the insights are, and then in conclusion we'll talk about some key things you can think about to improve the odds of a successful transaction and how to think about an approach to the market as we sit today. But to start, I'd like to tell you a little bit about Equiteq briefly, just so we can all, or you can all understand why we did this and who we are. Equiteq is a transactional advisory firm 100% focused on the professional services and consulting market. Equiteq was founded in 2004 by 2 partners who had grown and sold their own managed services, IT services business, and in the process of growing it and selling it realized that they had developed some key methodologies and drivers of equity value that they felt would be valuable to the broader market. Equiteq is very different from other transactional advisory firms because we are 100% focused on consulting, and we bring a significant amount of consulting industry expertise to the transactional environment. One important thing that allows Equiteq to do is apply our proprietary valuation model, which is designed to simulate the way that buyers of consulting firms will value an acquisition target during an M&A process. And so if what you see on the screen in front of you is our equity growth wheel, which is the result of the past 15 years of work in designing and developing methodologies to improve the equity value of consulting firms. And really the core methodology here and what we really do is try and de-risk the financial forecast of our client consulting firms in the eyes of a buyer. Equiteq is very active in the M&A market in professional services and consulting, both in Europe and in North America and Asia. So you see here some of the transactions we have closed. So now on to the research that we've conducted and the purpose of our meeting here today. We're here to talk about our 2014 Buyers Research Report. This was published by us in the last month, and we really saw a need in the market for very detailed and quantified metrics to describe buyer behavior, what buyers are looking for, how they value firms, how they structure deals. You know, we certainly in our work have developed a lot of anecdotal evidence for this, but we thought there was a need and a demand for very clearly articulated and quantified results. So we commissioned independent research. We didn't conduct the research ourselves. We commissioned an independent research firm to look at overall demand, the types of consulting firms that are in demand currently, how the buyers of consulting firms source their deals, how they structure transactions, and importantly, some reasons why transactions fail to close. Some of the main areas of risk when you're thinking about trying to close an M&A transaction. So the demographics of the respondents to the survey, you can see on the left the geographic profile, heavily oriented towards North America and Europe, but that really reflects the consulting market as a whole. If you think about where consulting firms are and where consulting revenue is really generated, it's overwhelmingly in Europe and North America. The industry sectors on the right, very diversified. So we at Equiteq track the broad range of consulting and professional services, and that broad range of sector coverage is reflected in the respondents to this survey. We felt that it was important that we had the input during this research of the people within buying firms that are actually making the decisions and driving the strategy. So you'll see here that there are the people that, overwhelmingly the people that responded to our survey were at the partner level or reporting into the board at the larger companies. And they're primarily in the global headquarters of the diverse larger buyers. So we felt that it was important to our clients and to you to know that you're getting the view of those that are really making the decisions, rather than the people at the buying firms that might simply be executing transactions. Okay, so now on to our insights. We always try in our research to be insight-driven rather than data-driven, which is why you'll see that we've organized this into key insights, because we want you to be able to walk away with very clear, actionable strategies out of this, not simply knowledge. So insight one relates to buyers' expectations of deal activity over the next 3 years. And it's clear that buyers see more opportunities for acquisitions, and they've, as a rule, have identified acquisitions as an important area of growth for their firm. So on the left of this page, we see really whether or not buyers are seeing more or less opportunities than in the last year. And the majority here are seeing no change. Very few are seeing less. And so this is consistent, in our view, with a healthy market that is not in a period of upheaval or change. I think if you were in a period more, for example, coming out of a recessionary period, you might see much more respondents saying that they were seeing more opportunities because the market is changing or growing. But we see the market is very healthy right now, very consistent activity. The deal flow is high, but we're not surprised to see most people seeing a consistent level of deal flow right now. As far as whether or not acquisitions are an important component of a growth strategy, it's clear that that acquisitions are uniformly important for growth in the professional services market. So, there are certainly firms in professional services that for whom acquisitions are more important than others. But across the board, we're hearing from the buying community that organic growth is not sufficient for the larger firms to be able to drive the kind of growth numbers that they need. So acquiring in key areas or key technologies or key service areas is critically important right now for the buying community, and it's driving an expectation for more M&A in the future. So what we asked the buyers, or our contracted firm asked the buyers, whether or not they were expecting more or less acquisitions in the future, and they said more, so that they were expecting this % increase. The average over the respondents was 3 acquisitions over the next 2 to 3 years. So we are seeing activity growing. This is leading us to believe that there is an increase in acquisition activity coming. And one other interesting data point: the average buyer acquisition budget, or a capital that's been earmarked for acquisitions, is $65 million. And as you would expect, it's higher for those that are prolific or that buy regularly, and a little bit lower for those that are more opportunistic as a strategy. But it's clear that from a seller's perspective, or somebody thinking about selling their business, it's a good time to do deals, and it's a good time to be thinking about selling. So before we launch into Insight 2, we did want to put up a quick poll for you to enter in some of your thoughts about what you might expect buyers' ideal characteristics to be for consulting firms that they're thinking of buying. So if you wouldn't mind here, we'll pause just for a moment, and you can make your selection here on the screen, and then we'll talk about the results of that in a minute. Okay, thank you for participating. So as we're looking at the results here, the majority of you have selected deep domain expertise and unique intellectual property. It's interesting that nobody selected geographical diversity, which is actually correct or aligns with our research, and we can talk about that in a minute. So as we look at the results of our research, we see we divided this into factors attracting buyers to a consulting firm and factors deterring buyers. On the left, the factors attracting buyers to a consulting firm, these are all very consistent with what we would have expected. And the one here that's interesting and that I'd like to talk about a little bit more is that tight geographical focus was relatively far down the list. But it does show up. So there's an interesting conflict here, actually, that this brings up as we think about the market, where particularly the larger buyers are looking for relatively sizable opportunities, because they would prefer to buy a $30 million business than a $6 million business, all else equal. However, they really want focus particularly in geography, and this is true more so for the Big Four than others. But they're sort of trying to have both their cake and eat it too, where they want things to be sizable and of scale, but they don't want it to be geographically diverse or diverse along the lines of services. But I think your response to the survey was on point, that financial stability and growth is most important. Deep expertise in a core service area is critical, and on down from there. On the factors deterring buyers from acquiring, culture is a very interesting lead response here. That difference in culture is a deterrent to doing a deal, pretty much across the board for the consulting firm buyers. And I think this is a topic that requires a fair amount of nuanced discussion, because it's actually not, in our estimation, a question of good versus bad culture, although it is typically framed that way by a buyer. In our mind, it's more of an A versus a B culture, and it's a question of cultural fit and alignment rather than whether or not a seller has the correct culture or a good versus a bad culture. So it's also very interesting to note that, we'll talk about this a little bit later when we talk about things that prevent deals from continuing or completing. Buyers evaluate culture in the beginning, and it's a key input into their decision to go forward with a deal in the early stages, but they don't diligence it at the back end. So once they're in diligence and once they've signed up an LOI, they're doing a lot of technical diligence and tax and finance and HR and all that stuff, and they're not doing cultural diligence. And so it almost would say to me that they're making decisions on culture that are relatively less analytical and comprehensive than their decisions about other more numerically oriented or quantifiable topics. So when I look at this page, I draw a line between, on the left-hand side, tight geographical focus, and on the being a benefit, and then on the right-hand side, a diverse set of services being a negative, a pretty significant negative. So again, this is sort of the cake and eating it too question. They want things to be focused yet large, and it's sometimes a lot of our clients are struggling with how to grow and when to make the decision to diversify, either geographically or by services. And it's a very interesting question when you're thinking about potentially positioning your business for sale, because you have to be careful about how you grow, and it's sort of the roadmap to that, or the conflict is really very clear on this page. I think this is a very interesting analysis. So as a closing on this insight, growth is critically important to buyers of consulting firms. I would say that growth is a validation of the offer. So very important to demonstrate growth. It doesn't have to be reflected in a specific percentage hurdle that's necessary. It's just important to demonstrate that your services are valued by the market. There's a significant interest in acquiring in the U.S. That's not a surprise. The U.S. is the largest consulting market, and there's many of the buyers we talk to that are in Europe and Asia are very interested in the U.S. right now. As far as the ideal target, around $30 million as a size, and this isn't intended to reflect the deals that are getting done necessarily. This is the desire of the buyers. They would love to have very focused service offerings of $30 million in a tight geography, and that's really just their Christmas list. It's not necessarily what they're able to execute. So for sellers, sort of lessons, I think that we're advising people to think very carefully about how and when to diversify, and at what point to think about new geographies and new services. It's not that you can't do it, certainly. It's just that you need to be careful about, if you're thinking about building for sale, you need to be very careful about how your diversity will appear 2 or 3 years down the road once you're ready to try and find a buyer. So it's important to think about. And then culturally, it's not important to try and match your culture to a buyer. What's important from our mind is to make sure you understand your culture, make sure you define it and the culture of your company is aligned to your strategy, so that your culture can be evaluated and easily, and you can use that to find the best partner when you're thinking about finding a buyer for your business. So insight number 3, where buyers source deals. We wanted to ask some questions around what their pipeline really looked like and how they manage their pipeline of potential acquisitions. On the left, this page is divided into where prolific buyers source deals and where regular buyers source deals. And we found that, not surprisingly, the more higher volume acquirers find most of their deals through either their own M&A group or third-party intermediaries like Equiteq. And this doesn't surprise us, because what they're doing is they're managing their pipeline and they're trying to ensure that they've got a healthy flow. And as we'll see later, in order to close a deal, they need to look at a lot. So they are trying to maintain a high volume of potential acquisitions, and you do that by building your own in-house group, and also by being very open to approaches from investment banks, transaction advisors, and other intermediaries. On the right, the regular buyers, this chart, which is more evenly divided, this reflects a more opportunistic acquirer who is finding a significant portion of their deals through their work in the industry. So the 30% slice there, those are existing relationships where they might be acquiring partners or other firms that they find themselves often working with to solve client problems, and they just decide to get together. So that's a more opportunistic acquisition program. The buyers on the left, they start a year with a target of doing 10 or 12 or more deals, and so they need to start the year with a healthy pipeline of potential acquisition targets. And the buyers on the right, they don't have a goal. They don't have a target. They might want to do a couple deals a year, but they don't care if they don't, and so it's much more opportunistic. One thing to remember here as a conclusion is that even the buyers with an in-house M&A group are very open and use the intermediaries as a source of transactions, and so they may like to say sometimes that they don't participate in processes and they don't talk to transaction advisors, etc. But they do. They would prefer not to, because it usually means a higher price that needs to be paid, but they will do it. And the other thing to remember is that we've had direct quotes from the buyers that direct approaches are very rare, so that it is difficult to get through that initial screen if you're an unknown entity coming directly to one of the prolific acquirers. It's just they really organize themselves around their established pipeline through their own M&A group or through intermediaries. So we're on to insight number 4 relative to deal structures and earnouts, and we've got another poll. We'd like to launch a poll relating to what metrics, your view of what metrics would be normally used by a buyer to set an earnout. So we'll pause for a moment while you input an answer, and then we'll come back. Okay, thanks again for participating in the poll. The majority of you selected gross margin profit and EBITDA as the drivers of earnout calculations and earnout targets. So if we go back to the slides and we'll take a look at what the buyers said. So you see that they overwhelmingly chose gross margin profit and revenue, and EBITDA was far down the list. And this is, I think, rightly a bit of a surprise to sellers, because you would expect profit to be the most important component, and you would expect, first of all, the value of a deal to be calculated based on the profit delivered by the selling company, which is overwhelmingly the case, and certainly our valuation model heavily relies on delivered profit to value a seller. However, when you're thinking about an earnout, the thing that makes EBITDA a difficult measure for an earnout is that the seller doesn't necessarily have control over it after the business is integrated into a buyer. So really, this just reflects a practical issue that the earnout is intended to be within the seller's control, and so aligning it to EBITDA is a little bit punitive, because the seller doesn't necessarily have control of all the costs. And so it's really a simple matter of making sure that the earnout is something that the seller can control and deliver, and not get discouraged by having it go sideways because there's administrative costs or something that they just didn't expect. So on the right-hand side, we talk a little bit about the proportion of earnouts that hit the target. And this is an interesting result, because what it says is that earnouts in this world, well, I'll tell you what it says to me, is that earnouts in this world are set up as a downside protection mechanism rather than an upside performance motivational tool. And so what I mean by that is that the earnouts are set so that they're mostly hit. And what we've seen in our transactional structuring conversations with our clients who are selling to the world of that have answered the survey, is that earnouts are typically designed to make sure that the business doesn't just sort of disappear. So they're not really set to encourage growth or to require all of the growth that was presented in the offering materials. They're really set to make sure that the business at least stays as big as it is at the time of the deal. And so that's why you'll see that the earnouts, the buyers will say that most of their earnouts hit the full target, and that they design earnouts to be mostly hit, because they really, at the end of the day, they're trying to make sure that they're getting what they thought they were getting, and they're not trying, or they don't want to set up something that's sort of immediately discouraging to the seller, where 6 months into a deal they could think, oh well, I'm never going to hit this, and just sort of get discouraged. They want to just make sure they've gotten what they paid for. Some other metrics here around transactional structuring. What proportion of the total consideration is paid up front in cash? We find that it averages around 50%, with a range of 40 to 60. So all this is saying is that it's relatively rare to get less than 40% cash up front in a deal, or more than 60%. Now, it's certainly possible to get 100, and we at Equiteq pride ourselves on our ability to deliver transactions with close to 100% cash at close, but it's not the norm, and it's unreasonable really to expect it. So we like to have this data point directly from the buyers, so that our clients who are thinking about selling their business are properly have their expectations about what the structure might look like properly set. And then on the right, what earnout period do you operate? Most earnouts in the transactions that we do are in the 2 to 3 year range, and that's validated by the data. So it's overwhelmingly in this world, the transactional structures will involve some form of earnout or deferred compensation structure, very common. And the earnouts are typically based on growth in revenue or gross profit, as I mentioned, because it's under the control of the seller. And you know, as I mentioned, realistic expectations are very important, very key. And as you're thinking about structuring a deal in this world, it's very important to make sure that you are comparing apples to apples when you're comparing two deals. And so we're very insistent in our processes on making sure that buyers tell us everything about the earnout and everything about the structure and the timing and the kind of consideration and when it will be received, because there is it's very common for buyers to use the timing of payments as a negotiating tool, and so they try and move money around rather than paying more as a way to sweeten the deal. And so if you're not comparing apples to apples when you're thinking about one deal versus another, you can find yourself unable to make a decision because, you know, while one deal might have a higher headline price, the likelihood of receiving it is lower, and you only know that if you have full information. So our final insight relates to deal opportunity failure rates. And what that means and what it's talking about is how often a buyer will complete a transaction that they start. And when I say start, I mean from the first time that they're aware that a potential target is for sale. And there are very clear stages at which transactions that are started typically don't proceed. And so we want to make sure that our audience and our potential clients and our clients have a clear view of when transactions fail to complete and why. So we looked at, on the left, what percentage of opportunities get rejected before an NDA is signed, and it's a very high number, particularly with the prolific acquirers. You know, they'll sign NDAs with less than 10% of the opportunities they look at. So what that means is they're getting an anonymous teaser or what we call a blind profile, where they're being told that that there's a company of a certain shape and size for sale, and they need to determine whether or not they want to take a look. And they look at a lot of opportunities that they don't proceed with. Their filtering at that phase is quite severe because they really don't have time to look at everything they see. And so if we look at the next slide, we'll see a little bit more detail on these sort of hurdle phases that I mentioned. The first hurdle being before an NDA is signed, a non-disclosure agreement is signed. The second hurdle being from the point at which they sign a non-disclosure agreement to the point at which they're in an LOI, or a letter of intent. And the third hurdle being from the signing of a letter of intent through to closing the deal. And if you look at on the left, the top grouping, you'll see this is an average across all of the respondents to the survey. And what it says is that a buyer will look at 100 opportunities in order to close one. So 1% of the opportunities they look at result in a closed deal. Now, it's important to remember that this doesn't mean that 1% of transactions that are out in the market close. What it means is, from a buyer's perspective, if they see 100 deals, then they'll close one of those. And so what it says to us, and what the guidance that we give to our clients, is that it is very difficult to pick a buyer in advance. And the reason is because there's so many opportunities for any one buyer to drop out of a process, some that are related to the seller in question, and some that are completely unrelated to the seller in question, that are just you know, things that might happen in the market or the buyer's business. And so from our perspective, it's very important to remember that that a broad process is, from a seller's perspective, a broad process that includes as many potential buyers as you think might be relevant, or we think might be relevant, is the best way to improve the chances of getting to a closed deal at the end. Now, its broader processes are sometimes more difficult to run, and they're more time intensive, but for this purpose, the lesson is that they significantly increase the opportunity to close the deal, because there are so many reasons why one individual buyer will fall out during a process. So the conclusion and the lesson is that having more buyers involved is better than having just a few, but it's also that there's a significant amount of preparation that is necessary in advance to ensure that you get through the due diligence phase properly. So if you think about the life cycle of a deal, in the beginning, buyers are making fit determinations. If they see 10 potential acquisition targets, they might think one or two of them fit their business for whatever reason, and those are very quick decisions, and there's nothing really you can do about that. And you really want those selections to be made, because what you really want to do is engage with those that are the most interested in the best fit. At the end of the process, it's the inverse. You've got one or maybe two potential buyers that are interested, and they're doing a significant amount of technical diligence on your company, and that's where you can absolutely prepare for that. You as a seller can know that you're in good shape. You can know that your financial reporting is solid. You can know that your sales pipeline supports the forecast, and it is supported by the historical performance against your pipeline in the past years. You can know that your taxes are straight, and that you've got your contract documentation in the right spot. And so that's something you can be confident in. And you can know going into diligence whether or not you are likely to have an easy or a difficult due diligence process. And the other thing that we asked about at this, with this group of questions was how long it takes to close a deal. And on average, the buyer said it took 4.7 months to complete a deal following a letter of intent. That is, struck me as relatively long. I think that's an average across all of their deals, and they also said that a use of an intermediary shortens that time. So I can only attribute that to that an intermediary might be an extra set of hands to help with pulling together data, and also may or should prepare the selling client for diligence, so that there is a little bit more, maybe some more organization to that diligence process. So we'll talk a little bit about conclusions. I do want to remind everybody that if now's a good time to type in a question if you've got one. We'll spend a few minutes on conclusions, and then we'll address questions. So if there's something you're thinking about asking, please get it typed in now. And we'll address those in a few minutes. So we've thought about 5 key strategies here that can significantly increase your chance of completing a successful sale transaction. The first is preparation. There is certainly an opportunity early to mitigate risks that we know are very common across deals in this sector, but also to demonstrate the inherent value of your firm, to clarify your culture, to prepare yourselves for diligence, all those kinds of things. And that's obviously that's something that we're at Equiteq we are very focused on helping clients through that phase prior to launching a sale process. The second strategy is to clarify your value to different buyers, to think about the different buyer groups, the strategic parties, versus the financial buyers or private equity firms. Even within the strategic buyer universe, to think about the big four versus versus other less diversified or smaller consulting firms that might be in your space, and to know why different sets of buyers might like your firm versus another, or what they might be concerned with. Timing the market, number 3, is hard. Very difficult to, obviously it's not something you can control, but it's something you should think about. We've mentioned that we think now is an attractive market environment for selling a consulting firm, but it's not only the broader market that matters. It's your specific niche or sector. For example, if you're exposed to oil and gas client base, and the price of oil is important to their spending patterns, you just need to make sure you understand that, and understand how a buyer might view that, or view that as a risk. Number 4, I talked about a bit, casting the net wide. A large number of buyers at the beginning increases the probability of interested parties later in the process. It's very important to make sure that you're understanding the broader universe and making an informed decision about how many buyers to approach. And 5, keep your business growing and through the M&A process. M&A transactions can be very distracting, particularly in a business that relies on people to be delivering and selling directly with clients. Diverting those key people onto diligence processes and marketing and meetings can be, if not properly managed, can be very distracting. And so making sure that you keep the business growing for the 6 months of the process, so that you don't get to the end and have questions about your pipeline, is very important. So in conclusion, we think it's overall a positive picture for sellers right now. We don't see it changing in the near term. We don't see anything on the horizon that would change our view, other than unpredictable macro events. Buyers are very specific about their acquisition criteria. They're interested in the U.S. They like firms in the $15 to $40 million U.S. revenue range. That's not a hard and fast rule. It's just a preference. But they're also very specific about what they want, and it changes over time. And so it only reinforces our view that you need to make sure you're casting the net wide, because buyers are very particular and they're very quick to make no decisions. In fact, a lot of the bigger ones they enter anytime they see a new opportunity, they're trying to figure out how to say no, and it's the ones that they can't figure out a no for that they end up going forward with. Buyers are more likely to use intermediaries or their own M&A operations for sourcing. Most buyers seek an earn-out. It's just overwhelmingly the most common way for them to structure deals in this environment. Taking them off of an earn-out requires a competitive process, and requires a real specific set of circumstances to get that through. But most importantly, it requires negotiating leverage by having more than one interested party. And finally, be realistic about expectation as you go to market. We always counsel our clients not to be thrown by the early rejections, because what happens is you go out to 100 and you get you get so many that say no in the first week that a seller can get discouraged and think that they made a mistake and didn't build an attractive business. But really, that's what you want. You want those that aren't serious to tell you a quick no, so that you don't waste time on them. Okay, so I'm going to answer a few questions now, and we've got about, looking at the clock, we've got about 10 minutes for questions. So we'll go ahead and run through some questions now, and I appreciate everybody that submitted. First question, intellectual property is among the top factors that attract buyers. Can you elaborate on this and how buyers view this in the context of evaluation? That's a good question. Intellectual property is one of the ways in which professional services firms disassociate their financial performance from the people that are delivering the service. And so the highest multiples, or the easiest way to get a high multiple, is to have a business that's got a leverageable financial base by using a technology or an IP asset as a way to scale the business. And so the intellectual property is something that's always a focus of the buyers, and they always want to know how is the IP codified, what form is it in, is it just in the owner's heads, or is it in a form that the junior consultants can use. So it's very critical, and we spend a lot of time with our clients who are preparing for sale, making sure that the IP story is a very clear and delineated one. And good IP shows up in high margins, and it also shows up in scalable growth. And so those things typically will be what the buyer points to when they're delivering a high value. But to the extent that it's due to the existence of good IP, it's very important to value. Okay, so next question. We are a $3 million firm in a niche area of executive education. Our larger competitors are in the $50 to $100 million range. We've invested heavily in having an offering set and marketing presence to be set for doubling in size and doubling in size again. What's the reality of selling when we're $6 million in revenue, throwing off $1.5 million in profit versus where we are at $3 million? Well, I don't know that being 6 versus 3 would significantly change the chance of selling. I think that if you've got a good niche and you've got a leadership position in the niche, then your expertise and your ability to scale that expertise within a larger buyer could be identified as a driver of a deal now at $3 million. So it depends on what's happening between 3 and 6. If you're proving your product and proving your offer to the market, so that you're saying, at $3 million, there might be some questions about whether or not we've really got an offering that's valuable to the market, then it would be important to get to 6. Clearly I don't know if there's also at $3 million, an element of, you need to scale to a certain size before you're making the margins that you think are sustainable. But to answer the direct question, I think that 6 million, I think it's a reasonable size to be thinking about finding a buyer. But it all depends on how big they think you'll be within their business. And so if you're 6 million alone, but it's really a $12 million business in a couple years when somebody picks you up, then that's a very different question. Okay, next question. Can you speak to the mix and or trend of private equity buyers versus strategic buyers? Well, the longer-term trend with private equity is that they really, in certain sectors, they stepped out of the market after 2008, and in 2005, 6, and 7, private equities were buying a lot of professional services firms and paying too much for them because they didn't understand really how the models worked. And there was so much competition to buy anything in the market back then that they really got burned on some of their investments in professional services and probably overcorrected to the downside after the disconnection that started in 2008. However, we are seeing private equities come back strong recently, and we started to see about a year ago where private equities were starting to beat the strategics on value. Which seems to roll a little bit in cycles, but I would say that recently private equities have become very aggressive with professional services firms, and I feel like there's been a bit of a washout where what you're seeing now is the private equities that really understand consulting come back into the market aggressively, and those that felt like they got burned on consulting and never bothered to really understand the dynamics of these types of companies and how they work, those are still out of the market. But if you think about it as a trend, there was a big dip from 8 to 11, and now it's really come back, and the private equities are a strong participant in our processes right now. Next question, do the Big Four operate differently than other firms in the acquisition process? For example, do they pay a premium, longer earnouts, etc.? Well, I would say the Big Four do operate differently. First of all, they do most of the buying, so they're the most active acquirers. They're the biggest. They are very mechanical about it. They all have groups that do the sourcing, and they do the diligence, they do the review. They're fairly difficult to interact with. They like to run their own timeline and their own process. And the other thing about the Big Four is that PwC and KPMG, for example, are organized geographically, so they buy by country, and they don't like to buy across border, which is different than most other large consulting firms. And so they really don't like geographical diversity. They want you in the U.S. or in London or in France. They really want you to be in one place. As far as pay a premium, I don't think so. I actually think that the Big Four are more likely than others to just stick on 1 times revenue type of multiples. So I don't think they pay a premium unless they find something they really need and really want. So if PwC, for example, is a great buyer if you've got a specific offering or specific expertise that fits into a hole that they've identified and they're having trouble filling. They will be very aggressive in that situation. They are otherwise not terribly aggressive, and they're so big, and the deals that they're seeing are so small relative to their size that they've said to us directly that they never mind walking away from a deal because it's just never big enough to matter to them, is what they say. But in the right situation, they're very aggressive and a very good buyer, and the Big Four typically do what they say they're going to do, which is nice. Okay, so last question. If the buyer merges both entities in a new company and placed its CEO, and replaced its CEO, how does the management team of the seller company sign up for the earnouts? Yeah, so I think this is a very specific question about if both entities come together and the management team of the seller is no longer running the business that was acquired, how is he or she participating in the earnout? So it's true. It's very difficult for somebody to sign up for an earnout that they're not a participant in delivering. So that would be a complicated deal to structure. But I would say if somebody has built and is running a consulting company that's sold into a buyer, and he or she is asked to leave, or is leaving as part of the deal, then they would necessarily they would end up being less exposed to the earnout. Probably not. They probably wouldn't be able to have a zero exposure to the earnout, but I think their exposure to the earnout would likely be proportional to their participation in delivering it. Now, even if they leave, they don't have zero exposure to the earnout because they've still built a company that needs to deliver to the earnout. So they're still responsible for, they can't, from the buyer's perspective, the seller can't make the full amount of the value unless the earnout is achieved. But they wouldn't, they probably would have a larger proportion of their proceeds at close rather than during the earnout because they're not around to deliver it. And they're also not, there's no need to incentivize that person to stay and deliver because they're leaving. Sorry, one more question. To what extent is leverage a factor in the mind of the buyer? Is a firm built on a higher leverage model more valuable? If by leverage, I think you mean the sort of the pyramid of staff. And so is a firm that is leveraging junior staff and then presumably more profitable, more valuable? And it's a good question, a very interesting question, because the answer is sometimes. And the reason I say that is because if a seller is selling and there's a significantly higher proportion of very junior consultants that are doing work maybe above their pay grade, and so the margins are much higher, that group of consultants still needs to be integrated into the buyer. And the problem with leverage is, particularly at the extremes, is that the buyer may not realize the leverage after the company's integrated, and they make no mistake about that. So the experienced and savvy buyers will always know, and they'll model the acquisition based on plugging a seller into their leverage model. So if a high leverage seller is selling into a business that's like them, just bigger, then they're probably not going to get the full benefit of their leverage model. If they're selling into as a new entity within another kind of business, like for example, they're selling into to an outsourcing firm as a consulting arm, that will continue sort of acting independently and be the sort of front end for an outsourcer's attack on a certain kind of market or sector, then they probably would, because the leverage would survive. So it really, to think about it, you need to think about whether or not the buyer is going to dilute the leverage as part of their own model. So I think we've reached the top of the hour, so I'll probably stop. If you have any further questions, I'd urge you to reach out to me or Paula directly. My information is on the screen. We will be sending out an email with the slides in email form, and we would welcome any follow-up after the webinar. So thank you to all of our attendees for joining us, and have a great day.
And thank you very much, David. Greatly appreciated.